I want to begin with something that most people will dismiss the moment they hear it. And yet, it is precisely this instinct to dismiss uncomfortable information that creates the mispricing, the opportunity, and ultimately the events that define new financial cycles. Today, the overwhelming narrative is that the crypto market is slowly recovering, gradually maturing, and inching toward institutional acceptance at a predictable pace. But beneath that calm surface, the signals I'm watching are not merely interesting, they're historic. They suggest a structural shift, a realignment of liquidity, and a pressure point forming in a place few analysts are even looking. And this time, the inflection isn't driven by Bitcoin dominance, institutional ETFs, or speculative retail cycles. The shift centers around an asset long criticized, long misunderstood, and now positioned at the junction where regulation, global liquidity needs, and macroeconomic instability converge. XRP is showing markers through data, not opinions, that point toward a breakout phase as the 2026 cycle approaches. And if the signals hold true, this breakout will not be driven by hype, but by necessity. The idea that XRP is entering a structural rather than speculative breakout phase requires abandoning the usual way most people interpret crypto market behavior. When markets evolve, the assets tied to real economic problems begin to separate from those tied to sentiment, and XRP is quietly moving into that first category. I don't base that on enthusiasm, predictions, or narratives. I base it on signals that rarely appear in speculative assets. What I'm seeing now resembles the early stages of an inflection point where the market can no longer ignore the divergence between what an asset is used for and what it is priced at. A speculative breakout depends on hype, retail influx, and emotional trading patterns, but a structural breakout forms when the surrounding economic environment forces the system to adopt more efficient mechanisms regardless of investor excitement. The global economy is moving toward liquidity scarcity, not abundance. Debt is becoming more expensive to refinance. Cross-border capital flows are under pressure, and banks are revisiting settlement costs that they once tolerated because liquidity was cheap. When liquidity becomes constrained, inefficiency becomes unacceptable. And that is the kind of environment where a utility-driven asset, one built for settlement, speed, and cost efficiency, begins to transition from optional to necessary. This shift doesn't generate headlines at first. It generates anomalies, rising transactional volume without rising price, weakening correlation with speculative assets, and growing institutional usage that doesn't reflect in daily trading charts. These anomalies are showing up in XRP now. They indicate that its trajectory is being shaped by forces outside retail speculation. Structural breakouts don't behave like speculative ones. They often form during periods of low enthusiasm, low volatility, and dismissive sentiment. Price remains quiet precisely because the participants driving the shift are not traders. They are institutions and systems adapting to macroeconomic pressure. By the time the market realizes the asset is mispriced, the revaluation tends to be abrupt because the underlying demand wasn't built on excitement. It was built on operational necessity. This is why the coming move in XRP is different. It's not the kind of setup that relies on social optimism or speculative frenzy. It's the kind of setup where the surrounding economic conditions push the asset forward regardless of market belief. And when necessity drives a move instead of emotion, the breakout becomes far more durable and far more difficult for the market to ignore once it begins. Volatility compression is one of the most consistently overlooked signals in any market because it doesn't create excitement, it creates silence. And most investors misinterpret silence as inactivity, not realizing that prolonged compression is often the precursor to the exact kind of explosive movement they claim to be waiting for. When an asset that once moved violently begins narrowing its price range over months or years, something structural is happening beneath the surface. Markets rarely compress without reason. Either demand is stabilizing, supply is being absorbed, or a fundamental shift is aligning the asset with a different type of participant. In XRP's case, the compression is happening at the same time its utility metrics are rising, which makes the signal even more significant. Historically, When fundamentals strengthen while volatility declines, the market is not ignoring the asset, it is mispricing it. And mispricing during compression becomes a coil. The tighter the coil, the sharper the release. This isn't a theory. It's a pattern observed across equities, commodities, and currencies. Commodities like gold have shown it before major monetary shifts. Certain equities showed it before corporate turnarounds. Even entire currencies have compressed before sudden revaluations driven by liquidity shocks. What's happening with XRP resembles those patterns more than it resembles ordinary crypto behavior. The key is understanding why this matters now. The compression in XRP isn't forming during a period of market excitement or bullish sentiment. It's forming during a period of widespread dismissal, regulatory overhang, and industry fatigue. That combination is rare. Assets don't typically compress when the world is ignoring them unless structural demand is increasing quietly, and the data suggests exactly that. Rising corridor volume, rising on-chain settlement usage, and a gradual decline in speculative churn. These are not the ingredients of a speculative pump, they're the ingredients of a suppressed revaluation. When the compression finally resolves, the move often appears illogical to those who weren't paying attention. They think something sudden caused it, when in reality the move began months or years earlier in the form of narrowing ranges and quiet accumulation. It's precisely this kind of setup that creates outsized risk-to-reward outcomes for those who understand the mechanics. Volatility compression is the market's way of signaling that the next phase will not look like the last one. And when fundamentals push in one direction while price stays flat, the eventual break is less a surprise and more an inevitability, waiting for its catalyst. The reason the 2026 cycle matters is not because it represents another predictable phase in the crypto market, but because it aligns with a series of macroeconomic pressures that are converging at the same time, creating an environment where efficiency becomes more valuable than speculation. Most investors still believe cycles are purely emotional phenomena, fear and greed moving charts in repetitive rhythms. But the coming shift is driven less by emotion and more by mathematical inevitabilities. Trillions in global debt must be refinanced at higher rates. Central banks are tightening liquidity rather than expanding it. Regional banking systems are under strain. Cross-border flows are becoming more fragmented, and nations are accelerating the development of alternative financial rails in anticipation of instability. When all of these pressures converge, the market doesn't reward the assets people want, it rewards the assets the system needs. Liquidity stress is not a theoretical concept, it's an observable one. You can see it in funding costs, in increasing defaults, in stagnant global trade volumes, and in the widening gap between capital demand and capital availability. Under these conditions, the cost of moving money becomes more important than the yield investors chase. Institutions begin to scrutinize every inefficiency. A settlement process that once cost a few dollars becomes unacceptable when multiplied across millions of transactions during a liquidity crunch. This is why assets engineered for low-cost, high-speed settlement begin to gain relevance during financial tightening. And this is precisely the environment forming as we approach 2026. The traditional rails, built decades ago, were not designed for an era defined by high debt, geopolitical fragmentation, rapid capital movement, and currency volatility. They were designed for stability. But stability is no longer the defining characteristic of the global system. Instability is, fragmentation is. And whenever the world enters a period defined by these pressures, new settlement systems accelerate out of necessity, not innovation. XRP Phi. TS that profile because it offers what traditional rails cannot. Rapid settlement across borders without the friction that becomes costly under tightening conditions. Most investors are still focused on speculative narratives, ETF approvals, retail cycles, and dominant coins repeating past patterns. They haven't connected the dots between macroeconomic instability and the increasing value of efficient settlement systems. But markets don't wait for investors to understand. They move when the structural environment demands it. And as the 2026 liquidity cycle approaches, the demand for alternatives to slow, expensive settlement infrastructures will rise sharply. XRP isn't positioned because of hype. It's positioned because the world's financial plumbing is approaching stress levels that make faster, cheaper rails a requirement rather than an experiment. One of the most revealing signals in any market is when an asset's real-world utility grows while its price fails to adjust. That gap between usage and valuation is where mispricing hides, and mispricing is where opportunity begins. XRP's current position reflects exactly this type of divergence. Settlement activity is increasing, institutional corridors are processing more volume, regulatory clarity has removed barriers that suppressed access, and yet the price continues to behave as though nothing has changed. Markets often lag reality, sometimes by years, especially when the asset in question has spent a long period under negative sentiment. Investors anchor to old assumptions because it's easier than updating their models. They continue to price based on outdated narratives instead of current data, creating a disconnect that becomes unsustainable once liquidity cycles shift. What makes this divergence more significant is the nature of the utility increasing. This isn't speculative on chain activity driven by hype or short-term enthusiasm. It's structural usage tied to real settlement needs. It's growth coming from entities that don't care about price movement. They care about efficiency, cost reduction, and settlement speed. When adoption comes from systems rather than traders, it tends to be quiet, steady, and largely ignored by the market. And that is precisely what's happening now. The signs are visible in corridor flows, liquidity partner expansions, and rising volume that has no correlation with speculative trading cycles. These are the kinds of signals that usually precede reevaluations because they expose the flaws in market pricing. The market's failure to price this correctly is not surprising. Sentiment has a strong gravitational pull, and many investors still view XRP through the lens of past regulatory uncertainty or outdated comparisons to more speculative assets. But markets don't reprice based on sentiment, they reprice when conditions force them to. The moment liquidity tightens further, the value of efficient settlement systems becomes clearer, and the market begins correcting its oversight. This kind of repricing tends to be abrupt precisely because it starts from a period of long stagnation. People assume nothing will change until everything changes at once. This is why the growing utility is so important. It isn't reflected in daily charts because charts respond to traders, not to infrastructure shifts. But infrastructure shifts ultimately define long-term valuation. When an asset is being used more than it is being speculated on, the price eventually follows the utility, not the other way around. And the wider the gap becomes between what the asset does and what the market thinks it does, the more violent the correction tends to be once the cycle turns. The pattern XRP is following now is the same pattern that historically appears when infrastructure level technologies are ignored until the surrounding system makes their adoption unavoidable. Investors tend to reward excitement, not utility. They chase narratives they can understand quickly, not the slow, silent build of something foundational. This is why infrastructure assets are almost always mispriced in their early stages. Whether it was the early days of cloud computing, when most analysts dismissed remote storage as unnecessary, or the early period of e-commerce payments when online transactions were seen as a niche convenience rather than a future standard, the market consistently fails to recognize the value of systems that quietly enable other systems to function. XRP fits this template precisely because it is not designed to be the story. It is designed to be the rails beneath the story. The irony is that infrastructure assets often look the least impressive in real time because their progress is mostly invisible. Their adoption grows underneath price action. Their relevance increases underneath sentiment, and their value compounds underneath cycles that appear flat on the surface. The early cloud companies didn't show meaningful price appreciation until bandwidth constraints forced businesses to rethink their operations. The early mobile payment rails weren't taken seriously until global commerce demanded faster settlement. The parallels here aren't accidental. They reflect a consistent historical behavior where markets punish functionality early and reward it late, usually in a sudden and dramatic catch-up phase. XRP is occupying that early functionality zone now, and the market has not priced in what that means for the next cycle. What makes this setup even more familiar is the mismatch between perception and reality. The market still thinks of XRP as a speculative token competing with retail-driven assets, but its actual trajectory resembles the emergence of infrastructure during past technological transitions. The signals are subtle but unmistakable. Settlement corridors increasing volume without corresponding speculative activity, institutions integrating despite price stagnation, and regulatory clarity forming quietly around it. These are not the behaviors of a typical speculative asset. They are the early-stage markers of a system preparing to scale under pressure. The historical precedents show that once macroeconomic or operational strain forces institutions to adopt more efficient rails, the market reprices these assets rapidly because it realizes almost overnight that the foundation has been built while nobody was watching. XRP is following that exact blueprint. It is not waiting for speculation to return. It is waiting for the system to need it. And when the environment shifts, the market's understanding of its value will shift with it, not gradually, but abruptly, the same way infrastructure assets have always been reevaluated once their necessity becomes undeniable.